How's it going, guys? My name is Eish and welcome back to MoneyMetEish. In today's video, we are going to have a look at dividends. Now, this was going to be one video, but it was painfully long, so we have decided to split it up into a three-part mini-series about dividends, where we will have a look at, number one, what a dividend is, why companies pay them, what to look for in a dividend-paying stock. Then, in the second part, we will have a look at where do you find information on dividend payers, as well as the best way to utilize dividend-paying companies in your investment portfolio. And in the third part, we will have a look at the mistakes that people often make when investing in dividend-paying stocks. But before we get into it, please remember to like, subscribe and hit the bell notification, as well as following MoneyMetEish on Instagram and liking the page on Facebook. Please remember, this is not financial advice. I am not a financial advisor. This is a blank cup. Blank cups. Put your logo on my cup. My videos are for entertainment and education purposes only and should not be used as the basis for any investment decisions. Please also keep in mind that all investments come with the risk of a loss, and should you require the services of a financial service provider, please contact a registered financial service provider. So, now that all of that is out the way, let's get into the video. Easy Equities Investorverse has been a buzz about dividends since RMB paid their special dividend in April. But what are dividends? Why do some companies pay them? And why does the share price fall when a dividend gets paid? This and more in the video. So let's start at the very beginning. What is a dividend? A dividend is a portion of a company's earnings which it takes and pays to the shareholders. And the board of directors of a company will determine if a dividend gets paid at all, because not every company has to pay a dividend or can pay a dividend. Also, how often they'll pay a dividend, so whether they'll do it monthly, quarterly, every 6 months, or annually, and how much of a dividend they will pay. Some reasons a company might choose to pay a dividend are that they have done exceptionally well and generated a lot of cash, and they would like to reward, in a sense, their shareholders for holding the stock, so they pay out a dividend. Or it could be that the company feels like they don't have enough prospects for growth, and they won't be able to give the shareholders an adequate return on their investment if they, the company, invest that money. So they will give that money to the shareholders to do with what they wish. On the other hand, if a company decided to cut or lower its dividend or suspend it completely, it might mean that the company is struggling or in trouble, and then investors might be a little bit more wary to invest in that company, which could see the share price fall substantially. But how do we find a good dividend-paying company? Well, at a very broad, high-level view, you are looking for a company that A, is increasing its earnings every year, B, is not drowning in debt, and C, is growing its dividend every year. But that is very broad, and at a deeper level, apart from the 5 key attributes we always look for, which are revenue growth, earnings growth in EBITDA, whether the company has strong free cash flow, whether it has low debt, and whether it is well valued, we can also look at the payout ratio, the dividend yield, the dividend payment history, and the compound annual growth rate. So, number one, the dividend yield. The dividend yield is the dividend as a percentage of what the share price is at that time. So if a company's share price is 10 Rand and they pay a 1 Rand dividend, the company will have a dividend yield of 10%. The JSE's average dividend yield is between 3 and 3.5%, and the S&P 500's average yield is between 3.5 to 4%. Now, you might think that the higher the dividend yield, the better it is as a dividend stock. But there is a sweet spot for dividend yields. You don't want a yield that is too low, because it means you're not going to be generating enough cash. But if you have a dividend yield that is too high, it means the company might be taking on debt or might be under financial pressure in the future to continue to grow that dividend. And that dividend might be at risk of being cut. The sweet spot for dividend yield, in my opinion, is between 3 and 6%, which is sort of around the market average dividend yield to slightly above average dividend yield. The next thing we can look at is the dividend payout ratio, which is the percentage of the company's earnings that goes towards paying the dividend. So if a company has a payout ratio of 50%, it means that half of that company's earnings go towards paying the dividend. Whereas if a company has a 100% or higher payout ratio, it means that all of the company's earnings, or in fact, maybe the company is taking debt to pay that dividend. And that dividend is at risk of being cut or being suspended completely. The sweet spot for a payout ratio is anywhere up until 60-ish%, but it does depend heavily on the industry. Industries that are seen to be less favorable, such as coal and oil or tobacco, might have higher payout ratios as these companies need to pay more dividend to attract investors. In fact, one of the companies we own, Altria, which has around a 6 to 7% dividend yield, has a 77% payout ratio simply because of the industry they operate in, which is all of your sins, the smoking, the drinking, the weeding, all of them. So assess which risks you are willing to take. I don't think Altria is at any sort of risk of cutting their dividend. In fact, they are looking to target 80% as their payout ratio, so there is still room for that dividend to grow. The next thing we can look at is the compound annual growth rate, or the CAGR, which is the growth rate that has occurred over a period of time, be that 3, 5, or 10 years. I personally prefer stocks that have a 5-year CAGR of over 5%. If you're looking at companies with lower dividend yields, like Apple at less than 1%, you can offset that low dividend yield with a much higher CAGR, around 10 to 15%, and still consider that a good dividend payer. And lastly, another criteria to consider is the dividend payment history. Dividend aristocrats are S&P 500 listed companies which have grown their dividend payments every year for 25 years. And dividend kings are companies that have done it for 50 years in a row. Has this company paid a dividend every year and indeed grown its dividend every year over the last 5, 10, 15 years? Or do they pay a dividend, cut the dividend, not pay a dividend, pay a big dividend, pay a special dividend? Is it all over the show? We don't want that. It's a headache. We want nice linear growth every year. But a dividend history is not the be-all and end-all of dividend investing. A company that has paid a dividend for 17 years, like Microsoft, which is not a dividend aristocrat, could be a better dividend investment than a company like Coca-Cola, which is a dividend king, but has only grown its dividend by around a cent every year for the last 5 or 6 years. When looking for a good dividend payer, it's good to bear in mind that you first need a good company. Don't just focus on high dividend yields. If your company is not a well-run company, you are at a higher risk of not getting that dividend in the future, but still being stuck with the stock if the share price depreciates. So the first thing to find is a good company, which is why we still focus on our 5 key indicators and add the additional criteria later. I asked my followers on Instagram what questions they would like answered in this video regarding dividends. And the Vet1 Stradom asked, how long does an investor need to hold a stock before they become eligible for a dividend payment? In terms of dividend investing and how long you need to hold the stock, there are 4 important dates that you need to remember when dividend investing. First is the announcement date, and that is the date where the board comes out and announces that they will be paying a dividend. That announcement will say how much the dividend is and will also give you the next few dates, which is number 2, the ex-dividend date. The ex-dividend date is the first day that the share will trade without that dividend in its share price, which is also why the share price of a stock falls when a dividend is issued. The amount that the dividend is paid is equal to how much the share price falls, because that money is money that is leaving the company forever, and that gets reflected in its share price. So if a company has a 10 Rand share price and is paying a 1 Rand dividend, on the morning of the ex-dividend date, when trading begins, that stock will trade at 10% lower, or equal to how much of a dividend was paid. The ex-dividend date is also the date before which a shareholder needs to hold a stock. So there is not a specific length of time that you need to hold a share, but there is a cut-off date. If a company's ex-dividend date is the 10th of a month, and you buy the share on the 10th or later, you will not qualify for that dividend. You need to be on record as a shareholder at least 1 business day before the ex-dividend date to qualify for the upcoming dividend. And that's where, number 3, the record date comes in. The record date is a cut-off date set by the company where they take stock of all of the shareholders who are eligible to receive that dividend. And unfortunately, if you are not on record, you can't get paid. And number 4, the payment date, which is the date that that sweet, sweet dividend lands in your brokerage account. But not really, because you should be reinvesting your dividends and not seeing them at all. You should just be adding to that giant dividend snowball. So those are the 4 important dates when dividend investing. It doesn't matter how long you hold a share for, but rather the date when you buy in. But dividend investing really works much, much better over a long period of time. So that is the first of our 3-part mini-series on dividend investing. I hope you found this video helpful, and I hope you'll stick around for the next 2 videos. If you like this video, please give it a thumbs up, subscribe down below, and follow MoneyMetEish on Instagram and Facebook and everywhere where MoneyMetEishes are. We also would like to once again thank our sponsor, Blank Cups. Blank Cups. Put your logo on my cup. Thanks again for watching. We will see you in the next one.